Imagine you were invited to participate on The Price is Right, and the challenge before you was to guess the price of a single tulip bulb. Well, you would be forgiven to think they should go for just a few dollars, but speculators in the 17th century Holland paid the equivalent of around $1 million in today's money for a single bulb. What could turn a flower bulb into such a valuable asset? What forces drive us to such wild speculations? How can we recognize the psychological factors that underlie market actions? And how can we exploit them to build wealth? That's what we're going to be discussing today. Hi, everyone, and welcome to the Fireside, a podcast where we take you on a journey in search of financial independence. So grab your beverage of choice and sit with us by the fireside. I am José, your host for today, and I am joined by Miguel. Fahad is away this week, but he'll join us in a later episode. Before jumping into the episode, please note that we are not financial advisors, and opinions and thoughts expressed on this show are for entertainment purposes only and do not constitute financial advice. Please consult your financial advisor before entering into any trade. Now, in previous episodes, we have been discussing the news of the week, but after some discussion, we decided to slightly change that structure. And we're going to be focusing on things that caught our eye. The idea behind this is that we are consistently looking into news, market, actions, movements, and we will be touching on a couple of very quick points or news that we have read, rather than actually going into the news itself. Essentially, just maybe give a couple of pointers of the things that we personally are looking into. So for this week, various things we're looking for are the AMC. A couple of things we're looking for. The AMC merge. This is something that has happened, but is still going through various periods of volatility. The housing market, which you will not want to miss the next episode, energy prices, and cash as a position. Miguel, how are you doing, my friend?
Hey José, glad to be here, having another nice discussion on financial dependence, more focused on the markets today. I just want to start by touching on the cash as a position. This is the one that we've been discussing this week because neither of us has actually taken a trade this week.
That is
Yet both of
correct.
us were looking at some potential ideas. For me, for example, I was looking at a potential SPY short, but then at the end, I decided that it wasn't a good fit. Because actually, it was a good fit. I was just lazy.
You can say it. You can say it. You can say it.
So for me, I was looking at a SPY trade, a SPY shorts, and actually I thought it was a good idea. But in the end, either was it because of laziness or because of some fear of pulling the trigger, I ended up not pulling it, and decided that staying in the cash position was more valuable and to avoid the volatility.
100%. I think that's a great point. I have been looking more towards, as obviously you already know by now, probably, quite into the crypto sphere, and I've been looking at Bitcoin quite a lot. It has been going through this very choppy period, and it is probably one of the best times to take very small trades, kind of scalping. If you don't know what scalping is, just have a check on Google, because it's a very valid and valuable short trade you can take with a very small kind of risk to reward, but it is a trade, and if you can make money out of it, doesn't matter if it's $1 or 1,000. We're here to make money and build wealth. But on the SPY trade, I think a lot of the times, and because there's been so much volatility, I've caught myself in a couple of situations where I think it's been very difficult to understand where we are, and I think we're going to be discussing that of where we are in terms of the market itself. Um, but it has been difficult to take trades or to confidently take some trades. But maybe next time you should definitely should go for it. If not, just for science, so that you can share your experience.
Yeah, that's right. That's right. So today we wanted to focus more on the topic of market psychology, and as you said in the introduction, there were some phases of human history where we have seen what we call market manias in action. So the most notable one of them is the tulip mania that happened in 17th century Holland, where because tulips had been brought into Europe from Turkey halfway through the 16th century. They were a relatively new and modern commodity, and because they were rare and difficult to find varieties of, they grew in value and allowed for speculation. There was more demand for tulips than there was supply, and so this is what led people to even mortgage their houses and double mortgage their property to speculate on the value of tulips. And when we look back, it almost seems like a fairy tale, a made up story of having people pay, as you said, over $1 million or just about $1 million of today's money for a bulb. This was in the early days of speculation in Holland. So we can expect some lack of maturity in the markets. But hindsight is 2020, and the reality is that we have had a fair share of manias happen since we took a closer eye at the markets. The first one that our listeners may very well recall is the crypto mania. And I'm not saying that cryptos are, have as much worth as a tulip. I'm not saying that. I am saying that
I love the
in
disclaimer.
no, actually, I like cryptos as a fundamental project. I don't like most cryptos, but I think in an overall sense, I think there is a lot of value in having a few projects survive and thrive. But with that aside, if you look at a chart of Bitcoin a few years ago, you will see that it rose drastically between, let's say, 2015 and 2018. And especially in the last few weeks and months of 2018, it was exploding everywhere. And it was a mania. It was a mania because people who weren't active participants in the market were getting interested in the news and the media coverage of Bitcoin. It was becoming mainstream to the point where non-investors were looking to see if they would buy either some equipment to start mining, or they would buy Bitcoin without really knowing what a reasonable expectation would be for it, without knowing the project. Um, so this was undoubtedly a mania. Yeah, thoughts on this before we continue, Jose?
Yeah, I was involved in crypto from very very early stages. I'm talking 2012s, 2013s, where really was just a couple of people that love the project, and literally there was huge amounts of speculation around it. And the truth is that speculation, what is everything if not speculation, right? What is, the price of gold? Why is the price of gold what it is? And again, it's because that's the worth people give it to, right? Anything is valuable if we deemed it valuable, and that's just literally how the world works. Now, I think with Bitcoin and specifically Bitcoin, I think it's all down to various specific combinations of factors, right? I put it as, there was a huge network effect with Bitcoin. So there was a lot of people talking about it.
Mhm.
There was a lot of people saying, "Oh, this is like the revolution. This is going to change everything." And I think even before that, obviously with the miners and stuff like that, a lot of people were mining, and they were really not making that much money. Like, at the time that one Bitcoin was probably $20. But really, like, there was this fundamental belief that it was going to become something, and it took several years to get where it was. But what I find it incredibly fascinating is the network effect, and how much of an impact that will have on that speculation, right? Because all of a sudden, it goes from early adopters, or people that really just are into tech like us, and it starts to, when you start to hear your mom talking about Bitcoin, you know that there's something very special about to happen, or it has just happened, for that matter.
Yeah,
But yeah,
yeah,
yeah, go
exactly.
ahead.
No, yeah, I think you're absolutely right. And in fact, it is an indication that when the retail investor, or the late, how to say, the general public, when the general public starts to get engaged in these types of assets that are booming, that's usually an indicator that the movement's about to peter out, it's about to die. Jose, I know you're going to cover this later on when we talk about the cycle, or the psychological cycle, but it is true that it is just a translation or representation of the feelings in the market. When the feeling around a stock, or an asset, is of some uncertainty, that has potential, but we're not quite sure, uh, it may be a symptom that you're just a little early, that it still has room to grow. And by the time that everyone is absolutely convinced that it's going to go, quote unquote, to the moon, that it's going to be the vehicle for them to retire or to become millionaires, etc., that just means that all the hype is already there. There's no more hype to get beyond that. And when that happens, that means that it's got to go down, because when it stops going up, people will lose momentum, realize, have a reality check, they'll hop out. So there was a crypto boom, and I should correct myself. It wasn't until the late 2018. It was until late 2017, and early 2018 is when it started to go down. But just
Yeah.
to give you some quick stats, between January 2015 and December 2017, in the span of 3 years, Bitcoin rose 18,000%.
Jesus.
So that means that if you had put $100 on Bitcoin, you would have gotten $18,000 at the end of it, in the
It's
space of three
insanity.
years. Between March 2020 and April 2021, 13 months, there was another bounce of 1,582%. And so it's a 15 time increase, nearly 60. So another mania that I wanted to cover is the Tesla mania. So Tesla has got a great brand. I love the brand, and in many ways, I also love Elon Musk's brand, and he definitely carries a huge image, and he drives that brand forward. But even I would hope that the most stout Tesla defenders would be able to see that some of this data is really, really crazy. For example, Tesla is currently trading at a price to earnings ratio of 99.41. And that's at least 5 times higher than what investors would hope to be trading a stock for. And it's not the highest it's ever been for Tesla either. So a price to earnings ratio of 99.41 means that it's currently trading, the market cap of the stock is nearly 100 times higher than what they earn every year.
Right. Right.
By
Talking about
comparison,
speculation, right?
Absolutely. So basically, it's already priced into the stock that they're going to win the electric vehicle market, and not only win, but absolutely smash it and corner it almost entirely. But by contrast, you see some of their competitors in Ford and General Motors, their price earnings ratio is around five, between 5 and 7.5, which is much more
But how
balanced.
much of that do you classify it as like again the Elon Musk effect, right? Because you know I see it the same way as Bitcoin, honestly. The network effect. And for those that don't know, the network effect is more or less, and it is not going to be a scientific explanation. It's more like my interpretation of network effect. But really, network effect is how much of a particular thing, could be an asset, could be whatever it is influenced by a network, and in this case potentially a network of people or a social network, or multiple social networks. And how much do you think this, from this 99.41, right? And especially when you compare it to Ford and General Motors, like how much do you put that into the network effect, for example?
It's hard to say, but I will say that to the extent that it is maybe the brand, and Elon Musk's brand in particular, that gives so much confidence, and not only confidence, also just a sense of loyalty to traders and investors, that allows people to kind of crowd around this stock, because it really doesn't matter in the end. It doesn't matter that Tesla's PE ratio is 99, because if somebody's willing to pay more than that in a month, then it's a good decision to buy it now, right?
Yeah.
It's all that matters for a trader and investor is to buy it at a point that you have a decent expectation that you'll sell it higher for higher later. But that's, I think, precisely what's underlying a mania, is that the trading
Yeah.
is based on pure speculation on
Yeah.
what you can sell it to the next schmuck, and not
Yeah.
based on the actual current value of the asset. And that was the problem, just tracking back to the crypto boom in 2015, 2017, when a Bitcoin was worth nearly $20,000. The project was still really far away from a mature state. And even now, it still has improvements ahead of it, so before it can become adopted at a mass scale. So why were people paying so much for Bitcoin when they didn't even understand it? Let's be real. Most people that bought Bitcoin in 2017 did not understand it. Well, the only
Yeah.
reason is because they saw the price go up and they
Yeah.
speculated that they could sell it to
Yeah.
the next schmuck a year later.
Yeah. 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 100%. I still remember, again, my dad calling me and saying, like, this Bitcoin thing, everyone is talking about it. Like, should I buy some? Should I get some? And I was like, how much are you gonna buy? It's like, I don't know, like 50 euros or 100 euros or whatever. It's like, well, it's not really gonna influence much. But the truth is, just like Miguel said, if that conversation had happened maybe 5 years earlier, those 100 or those 50 would have turned into a substantial amount of money. But yeah, it's very interesting. And again, this is why for us, I think psychology is such a fascinating subject. Like, we're not psychologists. We're probably as far away in the spectrum as it can be in terms of being a psychologist, but psychology is present in every single thing we do on a daily basis, as long as it involves people, humans. And I think it's a really fascinating subject that hopefully we will be able to make it justice today. But I know you have a couple more, two more examples you want to go through, Miguel.
Yeah, I mean, I'll mention one just as a footnote, because there's a lot more than just the raw psychology of a stock mania, which is the COVID era, the COVID rally. There was a rally of 163.86% on SPY during just shy of 2 years, from March 2020 to November 2021. So about a year and a half. And this was a result of multiple things, but it includes also a new wave of retail traders that joined the space and were looking for the next hot pick. And within this rally of about 150% on SPY, there were multiple stocks that were jumping double or even triple digits in a matter of days. And a lot of it was down to newer, inexperienced traders crowding on a single stock one at a time, looking for the next hot pick. But the one I wanted to mention last was the last mania that we're still getting the last ripples of, and that's the Wall Street bets. Let's call it mania. A lot of some people call it, other less more flavorful terms. But if you look at GME, I still remember I was looking at this stock in April 2020. Yeah, it was April 2020. It had gone up from about $2 to around 20. And I was thinking, this is so high. I'm looking for an opportunity to short. And I was looking at all my parameters that I usually paid attention to. And I just couldn't bring myself to short it because I saw that the sentiment was so overwhelmingly positive, and the space was so crowded and the volume was so strong that I thought, in order to short this, I would have to have a much stronger confirmation. And so I didn't. And thankfully I didn't, because I would have shorted it at $20. And we
Oh,
all know
ouch.
that, yeah, it went up, I think, to nearly $200. But in statistical terms,
Over. It
from
went 360, I think. It was the very top.
yeah, that's right. So from April 2020 to January 2021, it's just under a year, it went up 18,693%. So that means that $100 of GME in less than a year would have given you $18,700. That is amazing.
It's incredible. It's honestly, it's just, you could say it's almost crazy. And what is crazy, right? If not a psychological um, term, right? And because really these things happen, and most of the times happen with no reason, as literally just people swarming in again, going back to that network effect. And you want to be in because of FOMO, right? Because your friend, and I have this example of someone that I know that got into the beginning of GME, and he sent me a screenshot of his account with $1.2 million, and he
Wow.
invested, I think it was $10,000, something like that. Obviously, to invest $10,000 on quote unquote a hunch or a joke, it's a lot of money, but still there was a lot of factors around it, and I think that on itself is like an episode just dedicated to the to that movement, the meme stocks, as a lot of people call. um
Just a question. Did he sell it?
he did, he did
Wow.
he did, and he quit his job next day.
Well,
uh
I would have done the same.
Yeah, yeah.
Wow.
He sent me the screen. I think I still have the screenshot. I can show you. But yeah, his basic account shows $1.2 million profit.
Well done to
So
him.
not too shabby. Not too shabby for a day's work. um. So let's move on to the next point, which uh, I'm gonna try and take you on a journey. We're all about journeys, and
All
and
right.
and really, what I want to do here is take you on a journey of what is the psychology of markets. Okay, and This is something. This is nothing new. If you go on Google and you search for psychology of a market cycle, you're going to be finding the image that I'm basically looking at the moment. But really, what on a very macro space, and for those that don't know, there's macroeconomic factors, microeconomic factors, and so on. A macroeconomic factor or a macro analysis is basically something that you take generally in a very long or very wide span of time, right? So really what we're talking about is probably something on several months to years, and that's generally when you can start to see these psychology markers. And really, the analysis that has been done by various analysts and psychologists is that generally everything works in cycles, right? Every market, and if you trace back, you're going to see there's cycles on everything. And a lot of the trading tools or the technical analysis that people do are based on those cycles, because kind of history keeps repeating itself and people don't believe it. But that's actually how it starts, with this belief. This belief is generally the the first psychological marker of a beginning of a cycle, right? So essentially, people just saying, oh, this is just going to fail like the others, and what's the point? And as I'm talking about this, try to picture Bitcoin on his previous rally, right? So you remember that Bitcoin went up to 20,000, monumental crash down, and then it went all the way up to the 60s, or 60,000s. And so have that image in your mind as I'm kind of describing this. And really, this belief is essentially when a lot of the big investors, or whales as they are generally known for, this is when they kind of start to get into the market. Institutions, people with inside knowledge, like investors, people that are actually invested into these companies, because again, behind all of these projects there's a company, there's a legal entity, or generally there's a legal entity. I'm talking about the like the top ones. But the same way that you apply to Bitcoin, you apply to almost any other stock. Look at Tesla, for example. Look at AMC, for example. You're going to see those cycles. So everything starts with a disbelief, and at some point, people start to kind of build up some hope. There's a belief there that, okay, maybe we are actually going somewhere. Generally, this is when you start to break not all times high, but like a previous high, for example. You kind of see the market shift. Things are different. It's not the same. So your feeling of this belief starts to change a bit. But at that point, and I'm talking about more like the general investors, general traders, retail traders like me, Miguel, and Fahad, and probably a lot of our listeners. That's generally not the point you get in, because a lot of the times you either have not heard about any of this, because again the network effect is not yet strong enough, or you are so incredibly bruised from the previous cycle that you're not going to get in. Like, you're just like still licking your wounds. You probably lost a lot of money, and you're just like, I hate this. Kind of like when you drink a lot and you get really drunk, and the next day you wake up and you're like, oh my god, I'm never drinking in my life again. It's kind of more or less the same thing, but you always end up drinking a lot of the times when you shouldn't, which again, that's how psychology of markets work as well. So at that stage, there starts to be a lot of hope and optimism, right? Okay, this is actually a real thing, and this is at the point that really you start to break all-time highs, right? So this would be probably the point that we just broke the 20,000 mark, right? And I'm talking about the newer cycle of Bitcoin. um and again, this is probably at the time that certain more savvy people that are more used to the market, this is when they're going to start to get in at this stage. And when we have, the belief is kind of building up, this is when the first kind of news outlets start to talk about, hey, Bitcoin has just broke all-time highs, and you're like, whoa, hold on. Whoa, what is going on? I didn't know. I haven't looked at the markets for so long. And you're just like, you really kind of start to believe, you start to speak with your friends, you're saying, hey, have you checked Bitcoin? It's like, no, what's going on? Look at it, it's like, it's going crazy. And it's like, oh my god, it's really going crazy. So this network effect again starts to build up. You start to speak with your friends, the tweets start to go through, the YouTube influencers and YouTubers, they start to posting because that content becomes you know important. They can generate money out of it, right? People talk about the things that generate money. Same thing with news, like the news sells what makes the money. And so this kind of all starts to build up to various stages of belief, thrill, and there's generally a culmination of euphoria, right? And at this point, this is when the vast majority of people get in, right? This is where, when you're kind of holding back and, you have never traded before and you're just like, oh, I'm not sure. Should I go in? And like, oh, but everyone's talking about it. Like the FOMO is literally killing you. You've just saw some of your friends just like going like, hey man, I've put in $100 and I've just turned $100 to $1,000. And it's just like, oh my God, this is like free money. And
Yeah.
this is at the point that everything kind of culminates. And remember that a lot of the problems we have with these things, and the reason why the markets move so drastically, is generally down to margin. Okay. So margin is generally what makes markets move violently, because of margin calls and liquidations. Not margin calls, but the liquidations. Really, what is a liquidation? And for those that don't know, either if you're long on a trade or if you're shorting a trade, you can go into a margin. And margin basically means you get a loan. It literally is a loan. You put some money, that's your collateral. That's the money that you lose if thing goes wrong. And generally, the broker will give you an upside, right? And that upside can be various degrees. But as an example, it could be a 3x. What it means is if you put a $10,000 in, they allow you to trade with $30,000. So you're basically getting $20,000 from the broker. $10,000 are your collateral. Now, if things are going up, you're just like, yeah, man, let's go all in. You, let's, remember when I was talking about the belief, the thrill, the euphoria? Generally, unfortunately, is at the thrill and euphoria stages that people feel invincible, right? Imagine this, like, again, psychology. You go in, you make a trade, you put $100, you're not sure. You're just like testing the waters, getting your feet a bit wet. And you've just turned $100 to $500, right?
Yeah.
5x. No biggie. And you're like, oh my God, like I can quit my job. I can make this a living. I can, like, I'm freaking invincible, right?
Yeah.
And that's at that at
I
that
figured
point.
out the markets.
Exactly. I see the matrix, man. Someone told me about trend lines, and holy crap, this is literally how it is. And so it's generally at this point that people go like, that little part of your brain that tells you, hey, you shouldn't really do it. This is when you're like, hey, shut up. I know I'm the boss here. You don't tell me what to do. And that's when you go into margin a lot of times, because you feel so invincible that nothing can happen, that you just, in your mind, is just that, oh, I made $400 in that trade. Well, if I had a 10x margin, I would have made $4,000, right? Or if I had whatever X it is, I could have, some brokers give you absolutely insanity of levels of margin, like 100x. Like that's crazy, right? And
Yeah,
so
I feel we should say, just for the sake of clarity, if you're hearing about leveraging or margin for the first time today, do not use it.
don't do it.
Even if you have heard it before and you think you know it, be very, very careful.
Yeah.
This essentially means that you're trading with money that you don't have. And the number one rule of investing is protect your capital.
Yeah.
So it is very risky to invest or trade with all of your capital. But when you're leveraging, you're trading all your capital and the capital that you don't have. And so
Yeah.
yeah, like Jose is saying, and he's just going to go, about to go into the flip side of this. But as he's saying, you can have really wild, trades that fill you up with adrenaline and will turn out good. But you can also have one single trade that wipes you out. And
Yeah.
sometimes it wipes you out for money that you don't have at your broker's account. You have to, go into your savings to pay them back,
Yeah.
and hopefully just that.
Yeah. Yeah, 100%. And the reason why I'm saying this is because this has happened to me, right? One of the things that I want with these podcasts and these episodes to kind of, share our experiences and hopefully help other people not make the same mistakes. I am living proof. Like, it was one of the most horrible periods in my life, and this was with Bitcoin. I did it with Ripple, right? So I got into Ripple. I think it wasn't a lot of money. And at the time, this was just one of my accounts, but I got in, I think it was like with $1,000 or $2,000. And every month I was getting some money. And rather than putting money into like a more stable investment, like spot trading, I was just taking how much out of my percentage of my salary, whatever I put on savings, and I would put it into the margin. And like every time I would put, let's say I put $1,000 on a 3x cross margin, that's $3,000, right? It's an order of magnitude. So you see the account. Like, at some point I was like, oh wow, that's I've got a lot of money. I haven't got anything, right? But it really, really gets to you. Like, your brain tricks you to a certain point there. It becomes, it's like Miguel said, that adrenaline. Like, I was waking up in the middle of the night checking the the charts. I remember one day waking up and telling my wife, hey, we're up $4,000. And she's like, what? And I was like, yeah, yeah. That was the moment she should have told me, or I should have had the clarity, and she should have slapped me in the face and say, right now, pick up your phone and sell. Like, just in this instant, I will divorce you right now if you don't. And really, what happened next was May of 2021, where we had like one of the most brutal and violent crashes of Bitcoin. And that crash, you can go and see any liquidation graph. Like, these things are available public and analytics you can link into. Um, what happens is, that collateral that you have, there's this thing, the liquidation score, which is basically a number. And if that number goes below a certain level, let's say that 1 is perfect, anything below zero point 0.5, it starts to get a bit, dangerous. And anytime it goes like below, let's say, zero point 0.3, you get a margin call, which basically means the broker saying, right, so things are getting a bit hairy. You probably want to add some money, right? Because if you add money, you're increasing your collateral. You're basically, protecting your account, essentially. Or not protecting your account, you're protecting the broker. And if you continue to go down on that score, and let's say if that score goes down to like zero point 0.1, you just get liquidated, right? That's it. It's gone. What they do is they sell every single thing you have, right? It could be you're profiting, you're in a loss. All of those unrealized gains or losses become realized. And that's what happened to me. I didn't actually get liquidated. I sold everything uh quite a bit before. So I ended up still keeping part of my money, but I can say
Yeah,
that it literally wiped probably 70% of my portfolio.
yeah. Well, at least in the end, those trades, they're hard to close, because it's very hard to not get into the mindset of revenge trading, or getting back
Mhm.
what you lost,
Yeah.
especially when the losses are so severe. And to be fair, Let me say, you got by Ripple, but I got by Ripple as well. My
Oh,
worst trade, or one of, I think it was my worst trade, but if not, it's in the top bottom three, was a Ripple
yeah,
trade. I put, back in the crypto craze of 2017-18, I decided to put some money into a broker, and I split it up between various cryptos. Most of it was in Bitcoin and Ethereum, even though I already had a separate account just for Bitcoin and Ethereum.
right.
And then I sprinkled in a few $100 in Ripple, like a couple hundred in Dash, and like some other, altcoins that were in
Yeah,
everyone's mouths. And man, Ripple, I think I sold it when I had lost like 80%, 83% of that
yeah,
position.
yeah,
And honestly, I cut it, and after I cut it, it kept going down, but I just couldn't take it
yep,
anymore. I took like 20 or $30 out of a $200 position.
yep,
It really stung.
yep. Yeah, and I think well, I'm gonna go now through the opposite side of the coin, which is kind of like we've just went through all the positive emotions, the positive psychology, and I'm gonna go through the negative psychology. And I think as I'm saying this, if you've ever lost money in the market, try to remember those moments, and you realize that every single thing else I'll say you're gonna know that you've went through it, right? So the first thing generally is that there's generally like a shake event, right? And this shake event in this case, when we also with Bitcoin, was a massive liquidation that brought the price down from, I think it was, we had just touched 62,000, I think, and then it just crashed drastically to like around 53 or 54. So it wasn't, we're talking about like almost in $10,000. Like that's a pretty big crash. At the time there was like 20 something 30% that crashed. And that a lot of it was and you just I invite you to go and see the graph. You'll see that there's a bit of a dip, and then there's a tiny bit of a recovery, and then there's just like a dip, and then it's just like like a red bar bigger than your screen, and that's liquidation. That's essentially people that got margin called. Some people managed to put some money in. That's why the price kind of stabilized a bit there. And then it just crashes down there, because essentially what is what is a red bar is selling pressure, and that's selling from the brokers just selling all of your assets to the market. um Generally when this happens, there's a bit of a rally, right? Because the price will bottom. There's generally big whales that will come in, and they have like a certain amount of like Bitcoin. They'll say, I want to buy here, and generally the price will go down there. Prices tend to be magnets to certain levels, and there's a reason for that, and we'll touch this at a certain point. But generally there's a bit of a recovery, and that recovery generally is known as the complacency, which is basically people just saying, okay, whew, all right, this happened, we recovered a bit, no panic, things just need to cool off. You're gonna hear a lot of this wording, these keywords of cooling off. Things need to cool off. Just this just happened, but we're gonna be okay. And then all of a sudden things start to kind of drop again. This time not so violently, a bit more controlled, because again, all those kind of liquidations were, they shook the market out, they shook the new money out. That's generally what we say. And at the point that you break the previous low, let's say that in that particular case, the price went down to 50,000, and then we recovered to like 56. And then it kind of comes slowly down over a couple of days, enough time for people to come to their senses. And you then now break 50,000 again, like 49, 800. There's generally a bit of a shake event, because a lot of people will put their stop losses at break even. If you don't know what the stop loss is, we'll also cover this in a later episode. But if you don't know what a stop loss is, that's an even more reason to never ever touch margin ever.
Yeah.
Until you know what the stop loss is, and until risk profile, you don't want to do any of that. But really, at that point, some anxiety starts to set in because you're like, whoa, I thought we were just cooling off. We're not cooling off. We're just breaking the bottoms again. What is going on? And that's generally when things over a couple of weeks to months, people start to go from anxiety to you know to denial, like, oh, just okay, it's okay, like these are good projects, these are good companies, I'm sure this is not going to get much worse. And at some point you're going to get into panic where you're going to hear from your friends, the same friends that generally got into and got you into, like, to pump you. They're going to be the ones saying, hey man, I'm out, like, Jesus Christ, this is, oof, I almost lost all my money. And you're just thinking, I'm losing all my money, like, what are you talking about? And this is when the panic starts to set in, and you start to see a lot of news articles, those same news articles that pumped you up again. They're now coming in and showing you, like, breaking all-time lows, the money is leaving the market, and so on. And certain other kind of macroeconomic factors could be started to play as well. It could be, obviously, we have COVID. It could be logistic prices going off the roof, and all these kind of stuff start now to be connected. And that's when really the panic sets in, and you start to sell, or certain assets, you sell them, to the point you just basically you capitulate, and you just, like, go like, I'm out. You're so incredibly brutally bruised that you're just like, I've sold everything. I don't believe in this anymore. Why was I so stupid? Why didn't I listen to this? Why didn't I listen to that? Da, 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 da. To the point where you get into anger. You start to kind of try to blame other people. You blame people that told you to get in. It's like, why did you tell me to get in if I hadn't got in, and this and this and this. Here's, it's never your fault, and the truth is, it's all your fault. You're the person that presses buy, and you're the person that presses sell. It's all on you. um and then over time you just get into, like, a bit of a depressive state, which is like, all of my savings are gone, like all of my retirement money is gone, all of my, I remortgaged my house, and that all that money is gone. It's gone, like, it's not gonna come back, like, it's gone. um and at this point, generally, this is when the whole market bottoms. So it takes a while, for things, like months, for things to cool off. Now, we were actually talking about cool off, not the fake cool off that happened. Like, this is actual cool off. Like, months have gone by. No one is talking about it anymore. Everyone just left. It's kind of like an empty stadium. And it's at this point that the price starts to kind of slowly go up. And guess what? We get into the cycle where you just have the disbelief. This is when you're saying, oh, yeah, it's not going to go anywhere. Like, it's impossible. The price is never going to go up. And the whole cycle starts again.
Yeah, so basically, what you just described is a series of increasingly euphoric feelings on the upside. And when you reach peak euphoria, that means that there's no one, no more excitement to bring to this, so you have to come down. And on the way down, there's a increasingly more depressing and angry feeling, so, to the point where when you're at the lowest possible feeling, which is anger, and apathy at the end, then there's no more room to go down, because everybody that could have been burned by the stock or the asset has already been burned, and the price has stabilized. And so at that point is when it's ready to go up. So it really is about recognizing which feelings are in play, and
Yep.
and making a mental exercise to recognize that at a certain point you have to act against the feeling that you're having at the moment. So when you're feeling incredibly euphoric, you should ask yourself, is this the time to be greedy? There's a famous saying by Warren Buffett, which is be fearful when others are greedy, be greedy when others are fearful. This is a summary of the explanation, the excellent explanation that you just gave. So when everybody is euphoric, you should be fearful. You should realize there's no more upside in terms, at least, of the market euphoria. And when everyone is fearful and angry and they've got out of the stock, if you feel that the fundamentals are there and that the asset has room to grow, that's the time to go in. Because then when price starts to climb a little bit more, then you're going to get a new wave of hopefuls, which will be followed by optimists, and then by believers, and then by people chasing a thrill, and then by people in the euphoria. And then you sell. Of course, this is very easy to say in theory, very easy to recognize in hindsight. Um, but we can see situations nowadays with this Bitcoin movement, for example. Recently, we initiated this last run up of last year, and I remember one of the most how do you say, one of the wiser investors that I follow. He tweeted a very simple tweet saying, once we crossed $10,000, he tweeted a very small tweet saying, I don't think we're going to go below $10,000 again. After we'd crossed over and it had proved that it had stabilized and initiated a new run up. But then price quickly rose up from 10,000 to 20,000 and then to 25. And as soon as it reached 24,000, I read another investor's tweet, someone I don't give a lot of credit to, and he was, saying with a lot of emojis and exclamation marks and etc., 23,000 is going to hold, no one will ever take it from us, etc., etc. So basically, he was appealing to the thrill. And I read that and I was like, it's guaranteed. It's guaranteed it's going to break. I can see 10,000 holding in the long term. But 23,000, even if you go up, it's going to come down, even if it's just to dip a little bit to the 2017 highs. And so when certain assessments are made in a state of mind of tranquility and care, then it lends more weight. And when it's just under a thrill or chasing a thrill, then you have to be very wary of that information.
Yeah, that's a great summary, and it's a great example that again I think we go back to that. You need to be careful with the network effect, right? And I think that's where we're trying to get at it here is everyone says this, do your own due diligence. Don't just follow because someone said buy, you go and buy. Don't do that because there's a lot of times, you don't know if these people have been invested for, years in a particular asset, right? And they have other motives. You don't know if they've been paid to, there's because of the psychology, you know, uh, you, a lot of companies, a lot of people will take advantage of that psychology to manipulate the market, right? That's the reality. They hack the market. It's kind of like almost like social hacking, really, where you take advantage of a particular wave and you increase that wave, and then you turn that wave on its head, and you control all of that because of people's emotions. There's certain analysts that literally focus. They don't look at fundamentals. They don't look at technical analysis. They look at emotion. There's this very famous fear meter for Bitcoin, crypto as a whole, and you can see like the fear meter is like at 10 or 20, or like you can understand what is the emotion, the general kind of feeling of the market. And why we're saying this? We're saying this because understanding the psychology of things, and understanding the psychology of trading, or technical analysis, the psychology of the markets, how things move, will help you become a better investor or trader, whatever you classify yourself. And above all, it helps you to protect your wealth, or maybe even build on that wealth, right? Because really, tying back into why we're here, and the financial independence, you really can't achieve it if you keep losing money, right? It's just not going to work.
Yeah,
So
absolutely.
so having that, you want to have as many tools, and weapons and ammunition as you can, to essentially build your wealth in this kind of like, in the battlefield, because really the markets are brutal, right? They're absolute battlefields, and people get financially killed, really. And the same way that others, build their kind of generational wealth the same way. So just kind of wrapping up this whole, it has been a lot of information we've kind of put out there. And why does this matter? This matters because every single, technical analysis, every single fundamental has a core psychology behind it, right? Being them support, resistance, trend lines, Elliott waves, Fibonacci's, all of those have a certain psychology. And understanding that psychology, it's almost like you end up, I mentioned before, kind of seeing the matrix, but really is, it kind of makes you a bit of a neo, and you start to see a bit of the matrix and understand how these things work. And following on that, my experience where I lost a lot of money, that for me, and a lot of people say that in order for you to become a successful trader, you generally go through a wipeout event, and it's like a personal wipeout event. And that, those bruises, those injuries, um those scars are necessary to to make you understand the stakes, right? And that was, for me, was the key point that I said, no, 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 this is, if I want to do this again, and I want to, because I really do like it, and I want to achieve my financial independence, um I need to understand how this thing works behind the scenes. And that's when I started to look into the market psychology. I started to look into Elliott waves and Fibonacci's and so on, and not just looking at them, but really understanding the psychology behind them, because they work for a reason. They're not magical things that just happen to be correct sometimes. There's reasons for that. What's your final remarks on this, Miguel?
So we did one of our goals for today was that we would be able to provide some thoughts, some recommendations on how we can acknowledge that the psychological factors that are out of our control uh, are driving a lot of the price action. Uh, B, that we can also be mindful of our own psychological state, our own frame of mind, our own emotional state when we're trading, and take measures to prevent emotional trading from taking over. When we are trading out of emotion, it is very hard to remain profitable. And the biggest problem with emotional trading is that it doesn't have immediate feedback. Even systematic trading doesn't have immediate feedback. But when you're doing emotional trading, you don't really have something to evaluate later on. Because when you're just been burned, like we were burned by Ripple, what is the feedback that we can get by closing our Ripple positions and then reopening them, but with more leverage? Um, we maybe we may even get lucky, and that's the worst thing that could happen to us, because if we get lucky that one time, our feedback is going to be, all right, if you made a bad choice, just double down on that bad choice.
Yeah.
Eventually it will happen, because it just takes one time. It takes one time for us to make that over leveraging to be wiped out.
Well, there's nothing different on that. What you've just explained, there's zero difference between that or going to the casino. Simple as that.
True, true, that's true. And so the number one thing that I wanted to close out on is that the way to leverage this information is to find a set of tools that you can apply to your own trading philosophy and especially trading system that will resonate with you and that will help you assess what is the current feeling in the market. We're not going to touch into it in much detail today, but we will cover it in a future episode. I know that José, for example, likes a particular couple of indicators that he wants to discuss with us. I tend not to use many indicators. I use mostly uh, volume and support and resistance. Sometimes I use something else sprinkled on top, but it's mostly volume, support, and resistance. So this is the tip that I want to leave with you. You assess the psychological state of the market and then use that information and apply it to a set of principles or a set of rules that you use for your trading. But you let those rules take out your own emotional states so that you have something very concrete that you're following up on. And the psychological factor of the market can be an input in those rules and in those systems, but you're not just swinging it. You're making it a part of a larger system that you have backtracked, backtested, and that you know you have some some risk to reward ratio, some odds of success based on that system.
Totally. That makes a lot of sense. Building up your process, your mechanism is just a step. It's not going to be immediate. You are going to find a lot of things that don't work, and I think it's almost like relationships, where sometimes in a relationship it's almost more important to know the things you don't like than the things you like. And I think with trading is the same thing. It's almost important to understand the things that don't work, because then they otherwise they just become out of like false positives, or just fake data that you're kind of relying on. So it's really important to kind of take those away, things that don't work for you, right? Because every trader, every investor has its own kind of profile, and you need to find yours. And once you do, and you find some of the tools that work for you, then you have your system, and then you apply that system, and sometimes it will work, sometimes it will fail, but your hopefully your win to loss ratio is going to be a healthy one.
Yeah, so let us know what you would like us to touch on more related to this topic. We would like to cover some of the indicators that we use for our technical analysis, and also I think it would be interesting if some of our listeners are curious to cover some of the manias that we've seen in the past, not only the recent past, but there's some interesting literature on these events, and maybe it's a nice topic that could dive into and then share with our listeners.
Agreed, agreed, agreed. So, on our listeners, where can you find us? We have opened a couple of different social media networks. So we've touched the network effect. We cannot escape it. You can mostly find us on Anchor FM, YouTube, Apple Podcasts, Amazon Music, and obviously, more importantly, Spotify. Whatever you're listening to us, a huge thank you for being here. We're really happy to have you. We're happy to be able to share some of these experiences. And, we want to hear your experiences, just like Miguel said. So, if you have some that you want to share with us, please do so. But until then, we hope that you stay cozy by the fireside.